Hi, we are going to look at the components of cost of capital. So it is very important for understanding the components of cost of capital. It is an essential factor in business valuation as it is used to determine the minimum return that investors require to invest in a company. The cost of capital is composed of various components of each of which plays a crucial role in determining the overall cost of capital. Understanding the different components of cost of capital is essential for a business to make informed decision about their financing options and to optimize their capital structure. The term cost of capital refers to the maximum rate of return a firm must earn on its investment so that the market value of company's equity shares doesn't fall. This is a consonance with the overall firm's objectives of wealth maximization. This is possible only when the firm earns a return on the projects financed by equity shareholders' funds at a rate which is at least equal to the rate of return expected by them. If a firm fails to earn a return at expected rate, the market value of the shares would fall and thus result in reduction of overall wealth of the shareholders. The cost of debt is the interest rate that a company pays on its outstanding debt. It is determined by the creditworthiness of the company and the prevailing market interest rate. The cost of debt is tax deductible, which means that the after-tax cost of debt is lower than the before-tax cost. Companies can choose to issue debt in the form of bonds, bank loans, or other debt instruments. The cost of debt is lower than the cost of equity, making it an attractive financing option for companies. The cost of debt is the interest rate a company pay on its borrowed fund. It represents the compensation demanded by the lenders for the risk they undertaking when providing capital to the company, because they invested their money for a particular period of time so for which the company has to compensate them in the form of interest rate. The cost of debt can be calculated by taking the average interest rate on all outstanding debt obligations or by considering the yield on similar debt instrument in the market. For example, if a company has borrowed $1 million at an interest rate of 5%, the cost of debt would be $50,000 per year. To accurately calculate the cost of debt, it is crucial to consider both long-term and short-term debt obligations. Along with that, it is essential to include the leasing obligations of a company. Next component is cost of equity. The cost of equity is a return that investors require to invest in a company's stock. It is determined by the riskiness of the company's business and the expected returns of comparable investment. The cost of equity is not tax deductible, which means it's higher than the after-tax cost of debt. Companies can raise equity financing by issuing new shares or by retained earnings. The cost of equity is higher than the cost of debt, making it a more expensive financing options for the companies. Let's look at the cost of equities in detail. It represents the return required by the shareholders to invest in a company's stock. Unlike debt, equity doesn't have a fixed interest rate, but instead determined by the company's perceived risk and expected return. One commonly used method to calculate the cost of equity is the capital asset pricing model, CAPM, which considers the risk-free rate, market risk premium, and the stock's beta. The CAPM model measures the systematic risk. For example, if a company stock has a beta of 1.2, the risk-free rate is 2% and the market risk premium is 8%. The cost of equity would be 11.6%. It is essential to regularly reassess the cost of equity as market conditions and the company's risk profile can change over time. Additionally, considering alternative methods such as dividend discount model or earning capitalization model ECM can provide more comprehensive view of the cost of equity. Next is cost of preference capital. The computation of cost of preference capital poses some conceptual problems. In case of borrowings, there is a legal obligations on the firm to pay interest at a fixed rate, while in case of preference shares, there is no such legal obligations. Hence, some people argue that dividend payable on preference share capital do not constitute cost. However, this is not true. This is because though it is not legally binding on the company to pay dividend on preference shares, it is generally paid whenever the company makes such sufficient profit. The failure to pay dividend may be matter of serious concern from the point of view of equity shareholders. They may even lose controls of the companies because of the preference shareholders getting the legal right to participate in the general meeting of the company with equity shareholders under certain conditions in the event of failure of the company to pay them their dividend. Moreover, accumulation of arrears of preference dividends may adversely affect the right of equity shareholders to receive dividend. This is because of no dividend can be paid to them unless the arrears of preference dividend are cleared. On account of these reasons, the cost of preference share capital is also computed on the same basis as that of debentures.